There are a multitude of types of businesses: large manufacturers, multinational corporations, individual service companies, professional partnerships, and more. Many firms make products to sell for profit. Others provide services. Some not-for-profit organizations provide services to people and their families, while others raise funds for important causes. Despite this variety of organizations and their differences, they all use a similar system to record and analyze their financial status. Generally Accepted Accounting Principles, GAAP for short, is an important set of rules, standards, and procedures used by the accounting industry. GAAP is based on some fundamental concepts. These concepts are the foundation upon which the accounting profession is built. The basic concepts include entity, money measurement, going concern, cost, dual aspect, objectivity, time period, conservatism, realization, matching, consistency, materiality. These words might seem a bit abstract, but each concept on its own is quite simple. Let's find out more about each of the concepts. A business entity is an organization created by one or more people so they can carry on trade or do business. The entity concept states that the business's financial transactions must be recorded separately from the personal transactions of the owner or employees. For example, Maya is the owner of a business called Maya Makeup LLC. In her business, Maya does makeup for brides and wedding parties. She needs to buy makeup products to use on her customers. That purchase is a business expense that she records in her business records. However, she also buys cosmetics for personal use. Buying makeup for herself is not a business transaction, and so she does not record that expense in her business records. Maya, the person, is different from the business entity Maya Makeup LLC. The letters after the name signify the type of business entity. LLC stands for Limited Liability Corporation, which is one type of business entity. Other entities include sole proprietorship, partnership, corporation, and S-corporation. Each type of business entity has benefits and drawbacks. A business owner will consider many factors when choosing the best entity type, including the goals of the company, the nature of the workforce, as well as legal and tax considerations. Many business people seek advice from attorneys and accountants before they choose an entity type. In accounting, the term money measurement means that only transactions and events that can be measured in monetary terms are recognized on financial statements. For example, when a company ships a package, the cost of the cartons and packaging materials can be measured as a dollar amount. However, various things can't be measured in monetary terms, such as the skill level of the employees doing the shipping. If employees have low skill levels and don't work efficiently, it can impact the business. However, this fact will not be recorded because it cannot be measured in terms of money. If it can't be measured in a monetary value, and it's not a business transaction, it needs to be left out of the records. In accounting, financial reports are prepared with an assumption of going concern. The going concern assumption means that owners and managers assume that the business entity will remain in business and continue operating over a period of time in order to fulfill its commitments, obligations, and meet its goals. The going concern principle is related to the long-term stability of the business and its overall value. In accounting, the cost principle is a measure of the cash value of something. For example, if a company purchases new computer equipment at a cost of $20,000, the value of the equipment will be listed as an asset on the balance sheet at the original cost of $20,000 at the time of acquisition. Another example of cost principle requires that a name brand or logo not be reported as assets on the balance sheet. Even though name brands and logos are valuable, they are not included in the company's assets because the value is not quantifiable. Inventory is also recorded on a company's balance sheet using the cost principle. If a computer manufacturing company orders 10,000 circuit boards at $1.53 per unit from their supplier, the inventory of circuit boards is valued at $15,300. The cost principle is also known as historical cost. Any land owned by the company is also recorded as an asset on a company's balance sheets based on the historical cost principle. Even though the market value of the land may increase over the years, the balance sheet shows the purchase of the land at its historical cost. The dual aspect concept is based on the principle that any financial transaction impacts two separate accounts. This is how it works. Sam invites Sarah for a business lunch to discuss their marketing plan. They each order a meal, and the total bill comes to $100. Sam pays that bill with cash. That's a one-step transaction in the real world. However, in the accounting world, it's a two-step transaction. The dual aspect concept emphasizes the fact that every financial transaction has a twofold effect. Under the system, aspects of transactions are classified under two main types: debit and credit. $100 will be credited under cash, and $100 is debited under meal expense. It's the basis for the system of recording transactions called the double entry system. Dual aspect is a concept based on the fundamental accounting equation that states that assets always equal liabilities plus equity. Alex keeps and organizes all of his business receipts, invoices, bills, check stubs, and bank statements. All of these documents provide important facts about each transaction they represent, including date, amount, and the purpose of the transaction. Whether it's in paper or electronic format, source documents provide evidence of the transaction. Source documents support the accounting principle of objectivity. Objectivity states that the balance sheet, income reports, and other financial statements of an organization are based on verifiable, unbiased evidence. Source documents can include customers' invoices, vendors' bills, check stubs, bank statements, and cash receipts. Typically, the documents have a unique identifier using a numeric or alphanumeric code to help in referencing. A source document may be created in paper or electronic format. The source documents provide evidence for the initial input to the accounting process. Some businesses require weekly sales reports. Other companies want monthly expense reports. Quarterly and semi-annually are other common time periods for companies to prepare tax or payroll reports. In accounting, the time period principle assumes that all companies and organizations are able to divide their financial activities into certain time periods. Accounting or reporting time periods can vary and be any time interval required by the company. Many companies use the time period of a natural year, between January 1st and December 31st. And others measure a fiscal year, which is any 12-month period to prepare reports. Some items found on a financial statement cannot be measured precisely. For example, the monetary value of a company's inventory may vary day to day as goods move in and out of the business. If the balance sheet is produced monthly, it may represent the exact value of the inventory at the time it was prepared, but not at other times. Inventories are typically the largest current asset of a business, so they can greatly affect a company's financial statement. Many companies estimate their inventory using an inventory valuation. The accounting principle of conservatism guides accounting to err on the conservative or play it safe side of any transaction. That is, the conservatism policy tends to understate or undervalue assets or income rather than overstate assets or income. James is sending an invoice to a customer in the amount of $5,000 for the products his company sold and delivered to them. James cannot record that amount as revenue until he receives payment from the customer. Revenues are only recognized when they are realized. Realization is one of the fundamental concepts of accounting. An architectural firm signs a contract to design an office building. The signed contract represents potential revenue for the company. However, the architectural firm cannot report revenues for rendering services from the contract until payment is received in return for completed work. That is, the concept of realization in accounting dictates that revenue or income is only allocated to an account after that revenue is received. At the end of the second quarter, the bookkeeper of a small clothing store records all the expenses incurred in the quarter that are related to the revenues earned during the same period of time. This correspondence between revenues and expenses is called the matching principle. The matching principle directs a company to report an expense on its financial statement in the same period as the related revenues. The company sales are generated through sales representatives. The revenue for the month of April is $50,000. The sales representatives earn a 10% commission that's payable the 15th day of the following month. In this case, the 15th of May. The matching principle requires that the $5,000 commission expense be reported on the April income statement. Kelly owns a photography studio. For record-keeping purposes, she uses the cash basis accounting methods rather than the accrual basis. The principle of accounting consistency requires that companies should use the same accounting methods over time. That is, a company should not use one accounting method during one period and then a different method at another period. The consistency principle ensures that a company's financial statements for different periods of time, such as month to month, year to year, can be compared. Valid comparison of financial statements enables managers to more accurately evaluate financial performance. In business, paper used in the office is considered an asset. Imagine how impractical it would be for a company to try to account for every sheet of paper as workers use it for so many purposes. Practicality is the basis of the materiality principle in accounting. This principle states that only significant transactions need to be recorded. Consider a company that purchases a new wastebasket for $10. The wastebasket has a useful life of 10 years. Accountants could record the wastebasket as an asset and depreciate it by $1 per year. However, the amount of $1 in year is trivial and has an insignificant impact on the company's accounts over the year. The materiality principle allows the company to expense the $10 in the same year it was purchased. Items are considered material only if they could influence financial statements and the economic decisions of the users. Creditors, investors, or anyone else interested in the business would not be misled if the wastebasket isn't depreciated. The fundamental principles and concepts of accounting allow financial experts to prepare and analyze an organization's finances consistently over time. In turn, clear, accurate financial data enables business owners and managers to read, prepare, and compare an organization's finances, enabling informed business decisions. Hence, accounting is the basis of any successful business.